It's incredibly tempting to throw every spare dollar into investing the moment you hear about compound growth, stock market returns, or the magic of index funds. The stories are intoxicating. The janitor who quietly invested small amounts for decades and died a millionaire. The power of doubling your money every 7 years. The simplicity of buying the whole market and letting time do the heavy lifting. And yes, investing matters. In fact, for long-term wealth, it's non-negotiable. But here's what the excitement overlooks, and it's not a small footnote. It's the difference between a plan that works in real life and a spreadsheet fantasy that shatters the second reality intervenes. Without a cash cushion, one unexpected car repair, say, a transmission that fails at the worst possible moment, can derail your entire month. One medical bill, even with insurance, can land on your kitchen counter for hundreds or thousands of dollars with a payment due date that doesn't care about your investment strategy. One sudden job transition, whether you're laid off or finally forced to leave a toxic workplace, can leave you staring at 3 to 6 months of expenses with no clear income in sight. And in any of those moments, you have two unappealing choices. You can sell your investments at the worst possible time, usually when the market is down, because markets tend to drop precisely when the broader economy is struggling and people are losing jobs, locking in losses that might have recovered if you'd had just a few more months of patience. Or worse, you can push yourself straight back into high-interest debt, swiping a credit card or taking out a personal loan at 20% interest, which instantly evaporates any gains your investment portfolio might have earned. Think about that math for a second. The stock market historically returns about 7 to 10% per year on average. A credit card balance carried month-to-month charges 18 to 25% interest. If you have to choose between cashing out stocks at a bad moment or borrowing at that rate, you're not building wealth. You're digging a hole that your portfolio can't climb out of. Even selling investments in a downturn is painful. You're converting temporary paper losses into permanent real losses, and you're doing it exactly when your portfolio needs you to stay calm and do nothing. A simple emergency fund, even just 1 month of essential expenses to start, isn't lazy money sitting there doing nothing. It's not dead capital. It's not a sign that you're afraid of risk or that you lack ambition. It is, in fact, working harder than almost any other dollar you own, just not in the way you think. It's working as insurance. It's working as stability. It's working as the thing that lets you make calm, strategic decisions instead of panicked, reactive ones. When your car breaks down and you have $2,000 in a savings account, you don't have a crisis. You have an inconvenience. When you lose your job and you have 3 months of expenses in cash, you don't have to accept the first terrible offer that comes along. You can negotiate. You can wait. You can choose a role that aligns with your long-term goals instead of one that merely stops the bleeding. That cash cushion is the difference between selling investments in a downturn because you need cash today, locking in losses, and missing the eventual recovery, versus leaving them alone to rebound and grow. It's the difference between being a forced seller at market bottom and a patient owner who rides out the volatility. It's the difference between emergency debt that compounds against you and the quiet confidence that you can handle whatever comes next. And here's the hidden benefit. Once you have that cushion, you can actually invest more aggressively with the rest of your money. Without it, every investment feels risky because you know deep down that you're just one surprise expense away from having to touch it. With a solid emergency fund, you can buy stocks, index funds, or even slightly more volatile assets knowing that you won't be forced to sell them at gunpoint by a broken water heater or an unexpected root canal. So build that boring cash cushion first. Start with 1 month of absolute essentials: rent or mortgage, utilities, groceries, insurance, minimum debt payments, and critical transportation costs. Park it in a high-yield savings account where it's safe, liquid, and at least earning something. Then build to 3 months. Then 6 if your job is volatile or you have dependents. It won't feel glamorous. You won't see it on any financial influencer's highlight reel. No one posts a TikTok dancing to their $10,000 in a savings account earning 4% interest. There's no viral tweet about the peace of mind that comes from knowing you can pay your deductible without sweating. but it's the foundation that every single other wealth-building strategy stands on. Without it, everything else is fragile. A house of cards built on the assumption that nothing will go wrong, that your health will hold, your job will stay steady, your car will never break, and the economy will never hiccup. And those assumptions are lovely. They're just not true. Build the boring cushion. Then invest like a warrior, because you'll have earned the right to.